Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. Today we're going to ask a very simple yet fairly complex question on the Mutual Fund Show. How do you choose your mutual fund scheme? And it may sound like a very basic question on the face of it, but the fact is that it's not. You have to keep so many things in mind, not just your own requirements, but also the various kind of schemes out there. Do you want to go active? Do you want to go passive? Do you want to invest directly? What's your fund manager's track record? What is the churn rate of that fund? What is the Sharpe ratio? Now, I'm joined today by Aditya Shah, founder of Hercules Advisors, who actually put out a very interesting thread on social media. And Aditya, that's exactly where I thought we should, add all of those points and amplify them on the Mutual Fund Show as well. I found that thread interesting because it laid down some of these basic questions with such clarity, and those are truly big ones. Now, let's start with understanding why it's become tougher now than ever to choose the right mutual fund scheme. Is it because of a whole explosion of choices as well?
Absolutely, Tamanna, you are bang on. Zerodha is coming in, Sampo has come in, Helios has come in, and a whole host of mutual fund houses are coming in. So the problem really is there are thousands of schemes available, just like medicine. You don't know which scheme to select, what to look at when you are selecting a mutual fund. So there is a thorough process that I have devised for all our retail audiences that I put out yesterday, where you need to look at the fund manager's track record, churn ratio, Sharpe ratio. These are all some of the important factors that you need to really look in. Generally, what retail investors really do is, no, we don't want to go with a regular plan. We want to do a direct plan, and they end up choosing up the wrong scheme. And the cost of choosing the wrong scheme is tremendous over a longer term. So you need to go through a fixed process when you are selecting a mutual fund. The process, as we go on, we will discuss. So yes, it is becoming more and more difficult as explosion of mutual fund houses as well as mutual fund schemes come in, and you need to have a well laid down process about how you select a mutual fund.
All right, so let's start with the process, and that's thank you for that context, because it's truly not as simple as it seems. So the very basic understanding would be that active versus passive. If you're a newbie or relatively newer investor going for a passive fund, it's safer. If you have a bit of experience going for an active fund, but it's not as simple as that, is it?
Yeah. So the first basic differentiation that you need to do is an active or a passive fund. A passive fund is a fund that tracks the index, in India, the Nifty index or the Nifty Next 50 index. And a passive fund has an active fund has an active fund manager, where the active fund will try to create an alpha over the index. So what you need to really do is, you don't know whether an active fund or a passive fund, which one will outperform. So what you need to do is you need to create a portfolio where you have both active and a passive fund. You can decide the proportion of active or passive fund. 50-50 is fine, 60-40 is fine, but that's your call. But you cannot miss both the boards. You have to have both the boards inside your portfolio, a passive fund and an active fund. An active fund, the drawback of an active fund is there will be some years when they will underperform, but the upside is there will be some years when they will outperform. So a mixture of active and passive fund. If you are really very young, you need to be very aggressive on the active side of it, because you are taking a call that a good fund manager can outperform. As time really goes on, as you get older and older, passive funds should start to dominate your portfolio, and the proportion of active funds should really come down in the portfolio.
What is your cutoff for young and old? I mean,
So yeah,
you know,
so
because you have to go by this statistically. And you could be someone who maybe, Aditya, you will not define as young, but who is relatively newer to investing.
yeah, so how I define young and old is up till the age of 35, when you are able to take huge risks in the market. I define it as young. From 35 to about 55, I define it as a middle age where you are accumulating wealth. At that point in time, your mutual fund scheme should already have been decided. And now you should be doing a disciplined and a consistent SIP into all your equity schemes per se. And after 55 is really old, when you are trying to wind down your equity mutual fund investments, and then you are moving on to a debt product or a fixed deposit where you need to create a by the time you are 60 and you retire, you need to create a fixed flow of money into your kitty for your retirement purposes. So at the time when you are really very young, active funds, in my opinion, should start to dominate your portfolio.
Okay, the other interesting aspect I found in the process that you've mentioned is whether you go through an advisor and invest in a direct fund or look at a direct fund yourself. At what point can you make the judgment, okay, I have enough information, enough knowledge to invest in a direct fund?
See, what really happens is only 1% of the total public should go and invest in a direct fund, but it is the exact opposite. People are governed by the fact that we are able to save expense ratio, so we want to go and invest in a direct fund. That's not how people should approach it. People should approach it in such a way. Are you able to understand what the fund manager strategy is? Are you able to understand the churn? Are you able to understand what is the Sharpe ratio? Are you able to track the mutual fund 6 monthly and see how the fund manager's performance is? If you are able to do all of these things, then you should be moving to a direct plan. If you are not able to do all of these things, then you have two options. Those two options are: one, you could go to a SEBI regulated, SEBI registered investment advisor who could charge you some bit of money and then still put you in a direct plan. If you are able to do that, you will be able to save a lot of expense that you have got. The other way around is you can go to a mutual fund distributor and he will put you on a regular plan. He will look after all the portfolio that you have got and suggest as per your risk profile about how you want to go ahead and invest. So these are the two options through which you should be investing. Don't go straight away and invest in a direct plan and invest in 20 schemes because you don't understand the market. What you have to really do is either go to these two branches or straight away pure play, just invest in an index fund. There is no regular plans in index funds, just pure play invest in index funds. But for active funds, you need to compulsorily have an advisor who understands the market, understands the fund manager, and understands the scheme properly as per your risk profile.
Aditya, a couple of terms you mentioned, and I think it's only correct that we spell these out for our viewers. And whether you are going through an investment advisor or yourself, I think these are things that you should keep in mind. One is the fund manager's track record. You talked about the Sharpe ratio. What is that? The expense ratio. How much should it be, and where should you look for that information, as well as churn? Let's quickly go through these 3 or 4 concepts.
So a mutual fund fact sheet is a very, very important aspect of a mutual fund scheme. Every month, all mutual fund schemes publish this fact sheet. What do you find in this fact sheet? In the fact sheet, the most important thing is the fund manager and a fund manager's name. So you identify your fund manager from the mutual fund fact sheet. The portfolio of the scheme that you are investing in, the top 10 to 15 names of the mutual fund portfolio, which comprise about 60 to 70% of the holding, can be found there. The next important thing is the churn ratio. So what is the churn ratio? A churn ratio is how much the mutual fund manager is buying or selling in a year. The transactions. Some mutual funds have a churn ratio higher than 100%. So what that means is at the start of the month, the portfolio that they entered with, they don't have that same portfolio at the end of the month, and they are buying and selling constantly. What we need to really see is mutual funds where the churn ratio is really low. The fund manager is investing for the longer term and not churning way too much just to show the performance. So lower the churn ratio, the better it is. The better the mutual fund is being a long-term investor. These statistics do not need to be calculated by the retail investor. These are readily available in the mutual fund fact sheet. The next important point that you need to monitor is Sharpe ratio. While evaluating a mutual fund, you just don't need to look at the returns. You need to look at the risk-adjusted returns. What that means is the return that is adjusted for the risk that the fund manager really takes. A Sharpe ratio higher than 1 is really, really very beneficial for investors. It means that the fund manager is taking lower risks than the index while generating higher returns than the index. So always look for Sharpe ratios which are higher than 1, and those mutual funds over a longer period of time, if they are able to maintain a Sharpe ratio of higher than 1, is really, really very beneficial for the investor. The last point that you need to look out for is an expense ratio. Expense ratio is the fees that the fund manager is really charging for managing your money. For a direct plan, the SEBI has standardized all of these expense ratio. On a direct plan, the expense ratio varies from 0.4% of the AUM to 1.2% depending on the AUM of the mutual fund. On a regular plan, it varies between 1.6% to as high as 2.5%. So you need to see where your mutual fund is. Higher the AUM generally, lower the expense ratio is. But higher the AUM, the fund manager also finds it's really very difficult to deploy all of his money. So all of these three, four parameters can be found out within the mutual fund fact sheet, and all mutual fund houses and all mutual fund schemes publish this every month and can be found on the mutual fund schemes website.
This sounds like I said, this is a simple question, but the answer is not that simple. These are things that we very usually overlook. So I think it's important that you're highlighting them in such a clear and simple fashion, Aditya. Let me now come to the process. At the start of this conversation, you said that there is a clear process that should be followed. And is that something that you have codified? What would be that process as per you?
So this is a process that I have developed after 12 to 15 years of investing myself as well as advising clients. So the number one thing that you need to watch out is the mutual fund manager who is managing your money. We have ace investors like Shankar and Naren who work with ICICI. We have Rajiv Thakkar who works with Parag Parekh. We have Mr. Prashant Jain who was with HDFC Mutual Fund. So you need to look at the track record of these ace mutual fund managers. They will have 10 to 15 years of track record where they have demonstrated that they can create returns. You need to look at the portfolio and the style of investing. Some of the mutual fund managers exhibit momentum kind of an investing. Some of them do value investing. Some of them do a small capish type of investing. So you need to identify what is the mutual fund manager's strategy. And most likely, most retail investors would not be able to identify this. So for this exact reason, a distributor or a SEBI registered advisor is important. They will be able to identify the mutual fund strategy. Why this is very, very important is because every mutual fund manager will undergo a process of outperformance and underperformance. So during periods of underperformance, if you understand the strategy of the mutual fund really well, you will stay invested in that strategy and you will not try to look for the next best performing mutual fund. So point number one, understanding the mutual fund manager as well as his strategy is really very important. Point number two is look at those metrics, the churn ratio, the Sharpe ratio, the expense ratio, and the AUM that the fund manager is really managing. Then the last point is you need to look at your own risk profile. When you are really very young, you are allowed to invest in the small cap side of the market. But as you grow older and older, the risk tolerance of going towards the small cap side of the market really decreases, and you need to move towards the large cap side of the market. So the last point is look at your risk profile, and according to your risk profile within each category, try to come out to a best a good mutual fund scheme.
Aditya,
Right now, I
I
want to
think
warn.
of all the things that you've mentioned, the risk profile one may be, my guess is what is being followed the least. Because looking at small cap fund returns, everyone wants to, get those returns, and everyone wants to take benefit of them, whether they are, as you're saying, young, old, pre-35, post-35, doesn't matter. Look at the kind of investments coming in thematic funds. Look at where the money is coming versus what you are saying. Do you see a large divergence right now?
Absolutely. Retail investors have a herd mentality. So what they will try to do is they will try to chase the best performing funds.
Thank you so much, Aditya, for laying out so clearly the process that investors should follow while picking the right mutual fund scheme for themselves. Now, in this section of the show, we answer your questions that you've sent us to speak on this and answer some of your queries. I'm joined by Anant Ladda. He's founder for Invest Arch for Kal. Thank you so much, Anant, for joining us. Let me jump straight to the first query we have sent by a 24-year-old who says, my income is 8 lakhs per annum and I can invest 30 to 40,000 rupees a month. I aim to achieve my financial goal of creating a fund worth 30 lakhs in the next 5 years. It's from Aditya Tarade. He says, currently I have invested 5 lakh lump sum in Tata Banking and Financial Services Fund. So what funds would you recommend to me? I am comfortable with 100% equity exposure. Looking at the age, perhaps that's a good, mindset. Anand?
See, going 100 high. Firstly, very happy to be part of this show. Looking at the age, looking at his aggressiveness, his portfolio is quite balanced, I should say. But as in, uh, but his purpose is to reach a goal of 30 lakh by an age of 35. I think with an investment of roughly around 25-26,000 per month, and his present lump sum investment of 5 lakh, if he manages that fund properly, he'll be able to reach his goal very comfortably at an CAGR of 12%. Now, what he can do is for his balance SIP, which he want to do, he can frame some other goal. Probably he want to buy a home, a car, a vacation, or maybe plan for his retirement in advance, and he can do proper planning and start his investment separately and in a proper way, keeping a goal in mind. Having a goal is very important, and if you feel that you have some extra money which you can save for another goal, it's always better to map it to that goal and plan it accordingly.
All right, so that's good advice there. Let me quickly take the next query, and I'm trying to take as many as I can as fast as I can, because we want our viewers to see their questions on the show. Zaid has written in, he's 28 and says, I currently have SIPs of 10,000 rupees a month in equity funds. He's mentioned his current holdings as well: HDFC Defence Fund, that's 3 lakh rupees, UTI Innovation Fund 3 lakh rupees, SBI Energy Opportunity Fund 2 lakhs, and HDFC Technology Fund 1 lakh. He also has a 50,000 rupee investment in the Axis Small Cap Fund. So he says, my stock portfolio is worth 27 lakhs with 38% returns, and I can invest an additional 50,000 rupees. My goal is to retire by 35. What should I do? Zaid, first of all, what a goal to retire by 35. You have to think about what you will do if you retire by 35. But having said that, very impressive portfolio, don't you think, Anand, at this age and with the kind of investments?
So he has taken a lot of sector funds and a lot of sector calls, and I'm very happy that it's working out for him. And he want to retire by an age of 35. There is a very interesting principle known as FIRE. Financial independence, retire early. According to that principle, if you want to achieve a state of complete freedom, at an age when you are planning to retire, what will be your expenditure for per annum? At that age, you have to calculate that first and multiply it by 50. That is the amount of corpus you need to have before thinking of retirement. For example, if at an age of 35, his annual expenditure is maybe 10 lakh rupees, then he have to multiply 10 lakh by 50. If he has that corpus of 5 crores, then he can plan for retirement. Otherwise, he should probably revisit his goal and plan accordingly. Presently, he's working a lot of on a lot of thematic funds to give his portfolio a bit of stability and overall exposure. He can probably add a few multi-cap fund and maybe a large and mid-cap fund, which will give his portfolio a bit of stability as well. I know his theme have been working out well for him right now, but it's always safe to have some defensive bets also, and then and maybe some index bet also. For example, he can add Nifty 50 equal weight fund in his portfolio, which will give stability to his portfolio, so that his portfolio is properly diversified and taken care of even during difficult times.
All right, very quick question and answer, because I have little time left, but I don't want to let Harshit's question, just go to waste. 28 years old, SIP of 12,000 rupees a month. He's mentioned his fund categories. I'm not going to read them all out because they're on the screen as well. But he wants a 12 to 15% CAGR in the next 7 to 8 years. Now, you have that detail with you, Anand, so I will not repeat it. It's there on screen as well. What is your advice?
Firstly, very happy to see that he is investing a good amount of money in flexi cap and large cap, and he is accepting that in 7 to 8 period horizon, 8 years of horizon. Having good exposure in these cap is better. Probably instead of large cap, he can move to an index fund. And instead of Nasdaq 100 FOF, he can probably have S&P index fund, which will give him better exposure of foreign markets. Rest, I feel his portfolio is well balanced. And if there is no Six Sigma event, probably he'll be able to get a decent 12% CAGR on his portfolio with his given time horizon.
All right, great quick answers over here. Thank you so much, Anand, for joining us on the show. That's all the time we have. But do send in your queries to us on the Mutual Fund Show. That WhatsApp number is on the bottom of your screen, and with the detail that will help our advisors give you the best way forward. That's all the time we have for today, but stay tuned. A lot more coming up on the other side of the break on NDTV Profit.